Hey everyone, it's Tiffany with Money Talk with Tiff here again for another video. I wanted to keep these videos coming as I keep getting questions. One question that's popped up is, how do I invest? What is investing? How do I get started? Things like that. So I wanted to do a quick video and give you just some basic information about investing. Legally, I can't tell you what to invest in because I'm not certified to do so, but I can give you some basic information to get that started. So first thing you need to know, the market is broken up into two different categories. There's stocks and then there's bonds. So stocks are what the company issues out to get capital, get funds to invest into the business. So if I want to do an initial public offering, an IPO for Money Talk with Tiff, and I'm like, hey, I want to sell it for $2 a share. Whoever's interested, come by. Everybody will start buying the shares, hopefully. And then as those $2 investments start rolling in, I invest that into the business. And then as we become more profitable, the stock price starts going up because more people are interested, more people want to buy. And then also I can share those earnings with you as dividends that go back to the investors. So that's one side. Then the other side is bonds. With bonds, that's pretty much debt that the company issues to raise funds. So that's like you're loaning the company or the government or the municipality money. And then once it matures, so once it hits maturity, so say it's a 5-year maturity, 10% bond, and you invest $100, then every so often you'll get $10, $10, $10. And then once it matures after, let's say 5 years, you'll get your $100 back. So you get those coupons, which are kind of like interest payments up until the bond matures, and then you'll get the money you invested in back. So that's how bonds work. So bonds are a little less volatile than stocks, and stocks have more volatility. So if you are a high risk investor, you don't care if you lose your money, you don't care, you want to go all in, then you would have more stocks in your portfolio. If you're more of a timid investor, more conservative, then you would have more bonds in your portfolio. With me, I'm a high risk investor, so I have 90% stocks, 10% bonds. Now, when you're looking at investments, you need to keep in mind your risk tolerance. So that's how much you're willing to risk to make a profit. So like I said, for me, I'm 90% in stocks, 10% bonds, because I know I have a while before I cash that money out. Like I like to buy and hold. So even if the stock market was to drop, it wouldn't deter me. So that's how you know how your risk tolerance is. Now, with risk capacity, that's saying, say you're broke, you really don't have money to invest, your risk capacity is low. So even though your risk tolerance might be high, you don't have a high risk capacity. So that means you should not invest in like stocks, because you have to have a high risk tolerance and a high risk capacity in order to make it work. And like I said, this is very simplified, but I just wanted you to get the basic understanding of the concepts. So once you know your risk tolerance, your risk capacity, you know what percentage of bonds, what percentage of stocks you want in your portfolio. Another thing to look at is the expense ratios. So I would recommend not investing in anything if it has higher than a 0.5% ratio, because you can get ETFs, which is exchange traded funds, or index funds that have really low expense ratios. I mean, I have one right now and it's at a 0.03%. So, anything above a 0.5 is pretty much ridiculous in my opinion. So you want to look out for that, because the expense ratio is how much you're paying those investors to turn over those stocks, turn over those bonds, pretty much manage the fund, the ETF or an index fund for you, and therefore it cuts into your profit. So you definitely want to keep an eye out on that. Another thing you want to keep an eye out on is turnover ratio. With the turnover ratio, that is how many times they're trading those funds out for new funds. So the reason that's important to you is because if they do a lot of trades within a fund, then that can have tax implications for you. So you want something with a pretty low turnover ratio. So right now, like I said, I'm in a 0.03% expense ratio ETF. The turnover in that portfolio is only like 4%. So that's something important to look at. Another thing you want to look at is the 10-year history on the fund or the stock or the bond, because looking at the day, like today, the stock market's going down. So it's not a good indicator of what it can do long term. So you want to see something, with a 10-year track record. And then you can see how the stock market dipped and came back up and how that performed under those circumstances. So, in my opinion, I usually ignore the 1 day outlook. I usually ignore the 1 week, the 1 month, the 3 month. I usually look towards the 5 to 10 year mark and see how that fund is really doing before I pick it. Now, of course, like I said, this is very simplified. I just wanted to give you a head start, get you some knowledge on how to pick funds, how to invest. I want to keep these videos short, so I'll end it there. If there's something you want me to dive a little bit deeper into, just feel free to leave me a comment or send me a message, Tiffany@moneytalkwitht.com, and I'll be happy to make a video around that. But for now, I will sign off, and I'll see you next time. You gonna stop it?